If I told you there was a way to pay $0 in taxes on your retirement income, you may think I'm crazy, or maybe it sounds too good to be true. There's no such thing as a free lunch, right? Well, with some strategic planning, it is actually possible to achieve. Today, I want to show how our clients Charlie and Christina could pay $0 in taxes on $100,000 in retirement income. Now, this isn't a video about putting all your retirement savings in a Roth IRA. For Charlie and Christina, they are age 65 and retiring this year. So that strategy won't really help them. And even if they were younger with more time until retirement, it may not be the best strategy anyway. For most clients, $100,000 in income would put them in the 12% marginal tax rate, or $7,539 in taxes due. This is because only $66,800 of the $100,000 is taxable. The $100,000 is reduced by the standard deduction of $33,200, and that is made up of $30,000 in standard deduction for a married filing joint client in 2025 and the over 65 standard deduction of $1,600 per person. However, that tax is made up of different levels of tax rates. The first $23,850 of taxable income is only taxed at 10%, and the next $42,950 is taxed at 12%. That comes to an average tax rate of 7.5%. Now, this is at the federal level. This does not include any state or local taxes. All this is important to remember as we continue. Let's take a closer look at Charlie and Christina's retirement income plan. Let's begin with Social Security. Charlie has an estimated benefit of $3,000 per month, and Christina has a benefit of $2,500 per month, for a total of $5,500 per month. They have $400,000 in a joint investment account with a cost basis of $200,000. Cost basis refers to the original purchase price of the investments, which the IRS uses for tax purposes, including capital gains taxes. The dividends paid on this account are about 3% a year. They also have $700,000 in IRA and IRA rollovers from company 401ks. This adds up to $1.1 million in assets for Charlie and Christina. The cool thing about retirement and taxes is, for most people, they can pick and choose where the income comes from. Do I take income from the joint account, from the IRA and IRA rollovers, or from the Roth, or a combination of 2 or 3 of them? Let's see this in action with Charlie and Christina. So let's start the tax planning with their Social Security. Social Security is a baseline retirement income. We can't, other than determining when to file, manipulate the income to different tax brackets. I first want to show some fun things on how Social Security is treated when it comes to income taxes. You can see that when I enter $66,000 in total Social Security, only $500 of that is taxable. That is based on provisional income. What this means is that for a married filing joint taxpayer, if your provisional income is above $32,000, then a portion of your Social Security is taxed. Provisional income includes 50% of your gross Social Security. So in Charlie and Christina's case, half of the gross benefit is $33,000, which is just above the limit. Therefore, $500 of the benefit is taxable. As we add additional income from the portfolio or IRAs, more of the gross Social Security benefit will be taxed. So even with $66,000 in income, we are still showing a tax liability of 0. The next thing we are going to do is look at the dividends. Dividends from a tax standpoint are also baseline income. Unless they change to a 0 dividend stock portfolio, these are coming no matter what Charlie and Christina want. If you recall, their $400,000 joint portfolio is producing 3% of dividends annually. That comes to $12,000 per year. We are assuming that these are qualified dividends. Qualified dividends are dividends from company stocks that are held for a longer period of time, typically 61 days before the record date, or the date the shareholder must be on the books to receive the dividend. So now you can see that we are including $12,000 in qualified dividends, but I want you to notice the taxable Social Security. Because our provisional income has increased, so has the amount of taxable Social Security. So let's stop and take a second to determine where Charlie and Christina are. Right now, their income's at $78,000. $66,000 is from Social Security and $12,000 is from qualified dividends. but that's generating only $18,850 of gross taxable income, and that is reduced to $0 of taxable income because of the standard deduction. Now let's look at taking some money from their IRAs. You can see that we have income of $18,850 and a standard deduction of $33,200. I want to fill this tax bracket with taxable income. That will accomplish a few things. One, we can use the amount the IRS says we can at a zero tax, and two, I can slowly spend some of the tax deferred account so that at age 73, we could have less to take as a required distribution. This required distribution is something the IRS requires us to take whether you need it or not. It's all taxable income, and it could push you into a higher tax bracket. Now, this isn't a dollar for dollar amount. I can't just subtract $18,850 from $33,200 to determine the amount I need to take from IRAs. Remember, as I increase provisional income, the amount of Social Security that's taxed also increases. So there has to be a little bit of trial and error needed to determine these numbers. So let's start this at a $10,000 IRA distribution. This gets their income to $88,000, $66,000 from Social Security, $12,000 from qualified dividends, and $10,000 from taxable IRA distributions. So let's look at what's happening here now. More of our Social Security is taxed, and with the dividends and the IRA distributions, we now have a total IRS income of $37,350. With our standard deduction of $33,200, we now have a taxable income of $4,150. How is this not taxed? It's income. The answer is in the type of income it is. By taking advantage of capital gains, the $4,150 is considered in the 0% tax bracket. As a married filing joint taxpayer, you can earn in 2025 up to $96,700 and be in that 0% bracket. So Charlie and Christina are now at $88,000 in income and are still paying $0 in taxes, but we're still $12,000 short. Here I would look to the $400,000 joint portfolio. Remember, our cost basis in this account is $200,000. So for every $2 I pull from this account, $1 is a taxable gain. So if I need $12,000, I will generate $6,000 in capital gains to do that. So let's recap all of this. We have $66,000 in Social Security, of which $20,450 is taxable, $12,000 in qualified dividends, $10,000 in IRA distributions, and $12,000 in joint portfolio income, of which $6,000 is capital gain. This is the $100,000 they need for retirement income and won't be subject to a single penny in tax. Charlie and Christina were floored. They could have $100,000 in retirement income from a $1.1 million portfolio and pay $0 in tax. This just shows that if Charlie and Christina, or you for that matter, are smart about where your income comes from, you could also pay $0 taxes on that. Now, this is not always the case. And even for Charlie and Christina, this may not always be the case. It may not even be the case next year. But with smart distribution planning, a low to $0 tax liability in retirement is not out of the question. And again, all of this is done without them even having a Roth IRA. Depending on where you live, there may be state and local taxes. But from a federal viewpoint, having a low tax liability is very doable. The next step for Charlie and Christina is to think past this year. Think of taxes as not just a year-by-year analysis, but a lifetime look. Could we take advantage of low taxes now to harvest some gains in the joint portfolio? Could we look at a Roth conversion to put some of the IRA money in a tax-free account? It may be beneficial to get it to a tax-free account before age 73 when the IRS will require them to take money out. So for Charlie and Christina and for you, yes, it is possible to have a $100,000 retirement income stream and a $0 tax liability, but the more important question is, can we use this strategy over a longer period to minimize the total taxes paid over a 10 to 15 year time horizon, even if it means paying a little now? With proper planning, this is well within the realm of possibility. Our team here at the Noble Group is ready to work with you on building your very own financial plan. Reach out to us and schedule your complimentary strategy session today. Thanks for watching, and we'll see you in the next video.